Escrow accounts and mortgages can be confusing. The terms are complex, the numbers are endless. Without a working knowledge of the mortgage industry, it's hard to even keep up with your own numbers, which makes it hard to stay up to date when things like your escrow change. When there is a change, we send out a letter called an escrow account disclosure statement. A mouthful, I know, but it explains piece by piece what's going on with your escrow account so that you know exactly how your payment is being worked out. But even the piece that is supposed to explain your escrow account can be a little confusing, so let's go through the letter together to make sure that everything is as clear as it can be. The first couple of pages are just informing you what the letter in your hand is, and also some important notices about it, but mostly about credit bureau reporting. Then we get into the meat of the explanations. The first term we come in contact with is the computation year. This is just a projection, our estimation of what the next 12 months escrow payments will look like. We, or any other lender, could look at this at any time and recalculate the payment if something has changed. But the projection usually plays out all 12 months before that happens. This statement is for the next 12 months though, so don't worry about the computation year too much. Okay, let's run through the bullet points. On the first informational page, we take a close look at your account history. The starting T&I balance just shows how much you had in your escrow account when we did the analysis. Projected numbers are just a side-by-side of what was projected and what was paid. There may be some missing information here if we just took over your escrow account, as we only have information for our own accounts. Then, below all the nice charts and fairly small text, will be info about your monthly payment and account balance during the last computation year. This is just a breakdown of what you paid, how much of it was mortgage, how much insurance, and how much taxes. Again, we only have information about our own accounts, so if you just started with us, this may show up as a 0. The next page is your account projection. This is a detailed disbursement by disbursement breakdown of what we expect to see on your account. We'll talk about this more with our example, but basically this will show how much is in your escrow account at any given point, and how much is expected to be taken out for taxes and insurance. Finally, looking at the end numbers, the account projection summary shows what you can expect to pay with an exact breakdown of what you're paying for. The end result will tell you what you're expected to pay in taxes and insurance. It will add in your mortgage payment, and it will add any difference as a result of a surplus, shortage, or deficiency. Okay, that's a lot of arrows and boxes and a lot of explanations. But it's really a very thorough and a little long-winded way of saying, here's what you will find on the next 3 pages. But back to those terms I just said, surplus, shortage, and deficiency. Those are some terms that get thrown around that I want to spend a few seconds on before we look at an example. The low point, also called a cushion, this amount is the lowest level your escrow account is allowed to reach. The amount is decided by a lot of factors, but both federal law and our own calculations go into determining it. This amount is kind of, well, a cushion against unexpected increases in amounts. If it turns out that your taxes change in the middle of your computation year, the amount we have to pay out will increase, and we wouldn't have the money to do this if we didn't have this cushion in the account. Shortage. This is what we call an account that will end below the low point in the computation year. We have to account for this difference as a small increase to the payment that spreads out the shortage over 12 months. You may also elect to pay that amount all at once as a lump payment. Surplus. A surplus is the opposite. With a surplus, we're expecting to have more than the low point. If it's going to be more than $50 in surplus, we'll send you a check. But otherwise, we'll just apply the amount to your escrow account, which could lower your payment. Deficiency. This happens when your escrow account has a negative balance when we do the analysis. We have to bring this back into the correct amount, and we will, by default, spread that difference out over 12 months. You can also just pay the deficiency up front if you would like. Actually, a little more on deficiencies. These are common, and there's nothing to worry about. A deficiency could happen easily if your taxes increased, or your HOI increased during your computation year. For example, let's say your computation year started in January of 2014. Then there were local elections in February. Your town voted to pay for a new library, and your taxes went up in March as a result. At the end of the year, we do your analysis, and it suddenly becomes clear that back in March, the payments went up. Your taxes were all paid, of course, but now the escrow account has a negative balance, so your payment will go up, both to cover the cost of the deficiency for the next 12 months and the new tax rates. After those 12 months, if taxes or homeowner's insurance haven't gone up at all, your payment should go back down, since the deficiency will have been made up. Which is all to say, deficiencies are no big deal. We'll take care of it. We're just letting you know why your payment was affected. So we've been glossing over the actual numbers on our example letter here. But now that you're an expert on the terms and concepts, let's go through them. The account history in this example is for a new account. Thus, we don't have much of a history to show, and there is no former projection. Also, notice information about the last mortgage payment and its breakdown here. We didn't have an account before, so this doesn't have any data, but if there's been a change to yours, you should see your most recent payment amount here. Okay, that was pretty easy. Now for the account projection page. On the left-hand side, we see the amount that will be paid into the escrow account, and then the amount being charged for taxes or insurance on the right. You'll notice that for most of the month, there is more being paid in than coming out. In this example, you can see that the tax payments are a lot higher than your monthly amount. So the extra amount being paid on the other month is just preparing the account for the expected tax payment. On the far right column, we're just seeing the running total of the account, along with the required balance to keep the account accurate. You'll notice that in June, the account dips down to only having $275 in it. Remember the low point we talked about before? That's well below the low point, which we'll see on the next page. On the projection summary, we see that the projected payment is going to dip below the allowed low point, so we're going to need to make up for that shortage so we can keep up with the low point. Thus, we see the new payment information on the right. The principal and interest on the loan are coming to $687, with a $394 payment to the escrow account. But the shortage means we also need to charge $32 more a month to make sure we're okay regarding the low point. All of this added together determines the payment. Your example is going to be different from this one, obviously. But after watching this video and reading your escrow analysis closely, our hope is that you understand a few things that you may not have. Both that this letter is just informing you of a change, and that it should be crystal clear why the change has happened. As always, if you have questions, don't hesitate to call. We want to be your trusted mortgage professionals at any point in the life of your loan. Equity Resources, helping to improve the lives of families.